I'm delighted to say that we have an excellent and distinguished panel who are joining us this evening to give us their personal views and perspectives on some of the key themes identified in the Outlook. So let me introduce the panel to you. Firstly, to my right, I'm delighted to be joined by Wayne Snow. Wayne is Chief Risk Officer at Liverpool Victoria Friendly Society, the UK's largest friendly society and a leading mutual provider in the areas of both general insurance and life insurance. Prior to this, Wayne held a number of roles within the Phoenix Group, the UK's largest specialist closed life insurance and pension fund consolidator. Those roles included Chief Risk Officer, Financial Risk Director, and Corporate Development Actuary. Welcome, Wayne. Next to Wayne, I'm delighted to welcome Latisha Smith. Letitia is Group Director of Conduct, Compliance and Operational Risk at Lloyds Banking Group. Of course, very familiar to all of us as one of the UK's largest high street banks. In a career specialising in banking risk and compliance, Letitia has been the CRO at Climate Benson Bank and at Coutts and Compliance Director at the Royal Bank of Scotland. Welcome, Letitia. Next to Letitia, delighted to welcome Matt Holmes. Matt is the Head of Regulatory Policy for Deutsche Bank and is responsible for managing the bank's engagement with key regulatory policy debates globally. Before joining Deutsche Bank in 2010, Matt headed up the financial services practice in a leading UK public affairs consultancy. And prior to that, he worked as policy advisor at HM Treasury, covering financial services and regulatory issues. Now, turning to the home side, if I may call it that, very pleased to be joined by my fellow colleague and partner in Risk Advisory, Cindy Chan. Cindy is a partner in Deloitte's Financial Services Risk Advisory practice. She has extensive experience in supporting firms on governance and regulatory risk in areas such as the senior managers regime, product development and oversight, sales practices, and suitability. And to complete the panel, delighted to be joined by Vishal Bedi, a fellow partner in Deloitte's Financial Services Risk Advisory practice. Vishal leads Deloitte's capital and structural reform propositions and is Deloitte's EMEA leader for its risk and capital management service line. In that role, he works, not surprisingly, on risk regulatory and governance issues with many of the world's largest financial institutions. Again, welcome to you all. Now, I have a number of questions which I'm very keen to put to the panel, as always. However, we do want to make this webcast as interactive as possible. So we invite you all to ask your own questions to the panel, as well as the discussion proceeds. How do you do that? Well, on your screens, you will find a Q&A chat interface. If you type your questions in, you'll be able to see them, and I will try to raise as many as time allows us to do so on your behalf. So, without further ado, let's ask our panellists about some of the issues that David highlighted in his initial presentation. And the one I want to turn to first of all is actually the one David spoke about lastly, which is a subject close to all our hearts, value for money. Now, in the Outlook, we highlight how recently conduct regulators have been looking increasingly not only at the processes and sales practices around financial services, but also in practice the economic outcomes they deliver for consumers. So I wonder, Letitia, how do you feel firms should respond to this increasing emphasis? I mean, how can they show to the regulator that they're taking this matter seriously?
I think the topic of value for money, and I like the term value for money rather than just price and price focus, because value for me is much wider and there are many angles there. I think if your organisation is a customer-centric organisation, then value is intrinsic to the offering for your customer. And I think throughout the life cycle of a product and the product development, ensuring that you always consider the aspects of value for your customer, I think is essential for good management and good culture within an organisation. With value for money, I think the aspect of vulnerability is particularly important and one that we will see an increased focus of from supervisors next year and I think forever in the future.
Okay. So Wayne, just building on that, I mean, in terms of demonstrating to supervisors that the products and services you offer and provide do give value for money, I mean, how can a firm best go about that, do you think?
I think we do need to remember that value for money is really about the consumer's perspective. I think historically there has been a tendency for some firms to think that if you're not making excessive profits from a particular line of business, then that is evidence that you're offering value for money, whereas clearly it's much broader than that. I think being able to, to evidence that you are thinking about and that the board is really thinking about value for money for its customers by actively considering what constitutes value for money for them, because obviously in different industries it will mean different things. There is no one size fits all.
So it's
but
a
I think
concept rather than an absolute concept.
yes, but having the debate is really, I think, the part of the most important thing. And I think that value for money, certainly in the insurance business, does have a connotation with charges. And for that reason, I think has been quite contentious issue and quite a costly one as well for some firms. There aren't many finance directors who would proactively relish the prospect of reducing charges and taking a hit to the bottom line. But it's not just about charges, as Letitia was saying. It's about being able to have a product that meets customers' needs, no surprises for those customers, being able to demonstrate that when the customer pays for something, that they're actually using it and benefiting from it, that there aren't barriers to exit, and that they're getting a good service. And I think a lot of firms will think about that and think, yes, absolutely, we do that. Actually, when you try and really evidence that to a regulator and independent party, it can be quite a different story.
I mean, the regulatory focus has fallen particularly sharply on this whole issue of cross-subsidy between products and between groups of consumers. And any thoughts on that and how that can be acceptable to the regulator potentially?
I think it does come to something Letitia was also saying around who are those cross-subsidies with? Because if it's the vulnerable, then clearly that's not going to be acceptable. So from a conduct lens, I think the issue of cross-subsidy is a much more difficult one to justify. Clearly, the whole idea of a with-profits fund from a prudential angle is set up on the idea of cross-subsidization and sharing of risk. But I think when you view it from a conduct lens, then it's quite hard to justify.
Can I just build on that?
Please.
And I think if I look at basic bank accounts as a product, we would say that typically a large proportion of account holders could be determined as vulnerable. And when we look at the economics of providing a basic bank account, we would see that services provided to that customer group are higher typically than at the other end of the spectrum of our banking customers. But it's absolutely right that the largest UK bank has basic bank accounts available and continues to provide those. Yep. But then you do get into that very obvious question of who's subsidising some of those that cross-subsidy for some of those services for that vulnerable group. It's very real for us. I'm not sure we know exactly the right way to go, but it is, you have that dilemma between a principle and a principle of fairness, but also how do we deal with vulnerable groups too.
But obviously crucial to ask the question and debate various outcomes. Now, I'd like to turn to a couple of the emergent themes which the Outlook flags. And in our experience in previous years has been that some of these emergent themes very quickly become supervisory constants, actually. But at the moment, the two we flag are, as David said, IBOR reform and climate change. Matt, on IBOR reform, David highlighted that this has the potential to be one of the biggest transformation issues firms are facing, or there's complex program challenges potentially. And press comment has echoed that increasingly. I mean, how high a priority is it for firms, do you think? And why is it proving such a challenge?
So I think it should be a very high priority for all firms. I mean, certainly for my own institution, it's taken very seriously, and we've been working on it very hard for some time. But I think, as the outlook rightly flags, 2019 is the year where the rubber really hits the road on the IBOR transformation. There's a lot of work to be done in terms of building liquidity in new risk-free rates, on finalising agreement around fallback language, and there's work that still needs to be done there. And we have the looming deadline of the benchmarks regulation coming into force from the start of 2020 as things stand, and a long way to go in terms of switchover from IONIA to the new ESTA rate, let alone working out quite what's going to replace IBOR, or what reformed reformed Euribor will look like. So, I mean, these are issues that are going to come down the track very fast. When you think about the range of impacts across products, the range of clients that are going to be impacted here, the level of awareness outside of large institutions who have been involved in the discussions around the replacement rates to date, I think there's an awful lot of work to do. I think the only way that is going to get done is through coordination across the industry. And I mean, there's a lot of good work that's going on already, but that needs to continue. And I think there also is going to need to be close cooperation and coordination with the regulators themselves. I think we've seen the first step in that with the Dear CEO letter from PRA, and let's hope that we see other jurisdictions, other regulators follow suit in terms of making sure there is focus across industry, a coordinated approach to switch over.
Thank you. Vishal, from your perspective, I know you're talking to firms a lot about this. In where do you think the main challenges in this area lie for the next 12 months or so?
I think the way that we look at the moment and the work that our clients are focusing upon, we can almost chop it up into two bits. The first bit is the quantitative impact analysis, and really understanding the impact of IBOR. When often you initially talk to a client, you think about the issue, one often thinks about the derivative book. It's actually much broader than the derivative book. A lot of the attention focuses on that area. You've got to bring your loans, and it impacts corporates, and treasury functions get impacted in corporates and banks, and the impact of it is huge. So the first piece, I think, is really to work out what it means on your existing book, try and develop an idea, and it's not just LIBOR, which is again something everyone focuses on, which is changing, it's IBOR. So all of the interbank offered rates at some point will change. The UK has probably been the most vocal about how and when. The US has given quite a fair amount of information too. But some of the continental European countries, Asia, it's as big an issue for them in their respective bank offer rates. So it's working across your entire portfolio and thinking what it means. The second aspect, or the second chunk of work then, is the operating model aspect, and really thinking around what it means for how you, for example, price transactions at the moment, how you create transactions, how traders behave, how sales guys behave, the conversations you're having with clients, thinking around something which might, on the face of it, seem simple, but is incredibly difficult actually, when to switch across from one measure to the other. Is it in the interim period, you wait until LIBOR is officially abolished? That'll probably be too late. But if you do so beforehand, how do you make sure you're doing the right thing for your own organization and for the client? So a lot of these complexities are around how you actually do the business. And then there's the actual quantitative impact. And I think those two bits will be the core of the impact analysis and the follow-up work which is done over the next several months.
Okay. Now I'd like to turn briefly to climate change, the other emergent issue. And Matt, I know you've got a particular interest in this. Subject climate change, I think most would accept is a very important subject, but is it really a subject for financial regulation? Is it not a wider fiscal and political issue? Is it?
I think it's both. Certainly you can't avoid the importance of broader political action, and without that political action you're not going to get the clarity around transition, the movement to a low carbon economy that's needed. But equally, we can't duck the fact that there is risk in terms of existing assets on bank balance sheets as a result of those changes that will happen. We have commitments from the Paris Agreement signatories to reduce significantly carbon emissions. That will have an impact on economies of those signatories. As financial institutions, we need to take that on board, factor it into our risk analysis. I think the Bank of England consultation on this has highlighted the fact that everyone is aware of the emerging issue. Banks, others are doing work to understand sector by sector, asset class by asset class, what the implications might be. But that's different from taking a really strategic view as to what the implications of a transition to a low carbon economy is going to mean. I think whether we like it or not from an industry perspective, we are going to get increased scrutiny from prudential regulators. They're going to demand to see enhanced governance, clear statements of risk appetite, and they want to see new analytical tools, new modelling within banks to understand how we are managing the risk on our balance sheets. And I think we need to make sure that we are keeping up with that demand, not waiting to be pushed.
Fair enough. Now, on operational resilience, the regulators have been very clear that this is increasingly a focus for them, as much as traditional balance sheet risks. And they're looking to the boards to develop minimum standards of resilience, to develop their risk appetite in this area. But I mean, Letitia, given there's always going to be IT constraints, there's the ever-present threat of cyber attack, etc., is it meaningful for boards to be able to develop risk appetites in this area?
I think it's essential, actually. I suppose a couple of things that I would throw into the mix there, why boards should be very focused on resilience. I think if you look at customer expectations, when there is disruption in service, there is almost a zero appetite for any disruption. So you get a lot of media attention, which creates a lot of political attention, which creates a lot of regulatory attention. They all seem to happen instantaneously, and I think the board need to be equipped not only to respond and react to that, but to have thought in advance about what would be acceptable and what's not acceptable in terms of either downtime or disruption to service. And therefore, the approach that we are taking is under the 5 pillars that we have of resilience, is having individual measures to be able to have a individual risk appetites that we can then measure our performance against. But it is a reality that particularly when our infrastructure is run on IT, there will be downtime, actually. There will be problems. And as we've seen from some of the unfortunate incidents across the industry, one of the ways that we respond to that and respond to our customers in that moment, that playbook, I think is essential, actually, for good management.
Can I turn finally to Brexit? I do so with a little bit of foreboding, but I think we will steer clear from the wider sensitivities of this issue. But perhaps, Vishal, I mean, we are scheduled to leave on the 29th of March next year. From what you're seeing in firms, I mean, what remains to be done?
I think there's a fair amount that remains to be done. Part of the issue that firms have had, and the most prepared of the firms have been working on this for 2.5 years. Some actually even did some preparatory work before the referendum took place, try and think about what the consequences of a leave vote might be. So firms have been focused very heavily on this for quite some time. The issue that they've had, or that they're having at the moment, is it's around many of the activities that they've been putting in place are dependent upon having a regulatory authorization in place before they can commence. For example, recontracting clients to your entity, you can only do so to an authorized entity. Joining an FMI, you have to be authorized. There's lots of preparatory work you can do, but you have to have the authorization in place. And that's a journey they've all been on for quite some time. What's complicated that journey somewhat is that the regulatory expectations and the regulatory bar for what good looks like in the EU has changed. It's got higher over the last several months. And so what firms have been working to, which would seem to be acceptable and would have worked perhaps 6 months ago, 9 months ago, has changed. And what regulators are looking for, particularly if I give an example around broker-dealers, a derivative model back-to-backing into London, the level of reliance that you can place upon back-to-backing market risk into London. A great deal of that was acceptable 6 months or so ago, up to 100% in many cases. That's become under challenge from European regulators, and you're now looking at somewhere between, I'd say, 10 to 20% being actively market risk managed from day one, and the rest continues to be hedged into London, but then that would then need to be reduced over a 1 to 2 year period. Just that shift, however, has meant that the granting of licenses has been delayed. Firms have had to do additional work in terms of moving traders out there, looking at the risk policies, risk management people into destination. And it's just a small example of what there's many of where that bar has been rising, and so firms have been struggling. The other thing that they have been struggling with, without touching on the political debate, is the political uncertainty. Whether or not there's going to be a transition deal, whether or not there's going to be some arrangement from April onwards, what the final arrangements once the UK does actually leave the European Union might look like. What they've been trying to do is play a very delicate balancing game, pushing forward their implementation efforts, while at the same time not committing so much, or not committing too much that they may not need to commit in case there is a deal. And the best example, I think, the simplest example of that is moving people. They've, for very obvious reasons, firms have been very reluctant to move people in line with their original estimates and timelines, because is there going to be a transition or not? They've been delaying and delaying and delaying.
Yeah.
And it's when do they actually move them, and when do they take that jump? And that's then meant the regulatory piece and this implementation piece more and more has gone towards the end of the timeline, rather than, I think, in a normal set of circumstances, many of the activities which remain to be done in the next quarter, Q1 next year, would have been done last summer, probably, actually. And that ranges, as I say, from people, implementation, FMI memberships, final authorizations, client contracting. There's a lot to be done.
And just, Matt, if I may, in perhaps just a minute or two, peering into the future, it seems that the future relationship with the EU is going to revolve in some way around an equivalence type of concept. I mean, did you think that's sustainable for a market of this size and complexity?
Sustainable for the EU or for the UK? I mean, I think, look, certainly it's been no secret that for market participants, equivalence wasn't the first best outcome. If equivalence is tweaked, if it's enhanced, and I think there's certainly ambition to do that within the political declaration alongside the withdrawal agreement, then maybe some of those concerns, some of that nervousness from industry can be mitigated. But certainly, if you're trying to determine a commercial strategy and you're building on the basis of access arrangements that could be pulled within 30 days, it's difficult. It doesn't give you a lot of certainty. And I think the inevitable result of that would be a bifurcation of markets and fragmentation of liquidity in a way that probably isn't helpful in the long run to either side.
Thank you all. I'm afraid that's all we've got time for on these topics.